Hello, this is Jeremy Finger with Riverbend Wealth Management. Thank you for attending the call today. What we're going to be going over today is how to handle market declines. And before we get started, those of you who don't know me, I have my own firm with Riverbend Wealth Management, who uses Fidelity Investments, an $8 trillion behemoth in the financial industry that is privately owned. And as many of you may know, does a tremendous service to their clients as well. Also gives them great service and low cost. I grew up not far from Myrtle Beach in Nichols, South Carolina. Went to College of Charleston. Got my degree in biology and chemistry with the emphasis in business, and been helping people make good financial decisions for over 23 years. And I'm a certified financial planner and a certified investment management analyst, and I got that certification at the Wharton School of Business. So that being said, let's kind of jump right in and get started. You do have the ability to ask questions. There is a Q&A tab here now, and I appreciate your patience with me. This is the first time I am using this technology, but this is a wonderful, wonderful thing in that, as an advisor, being able to communicate timely, pertinent information to all involved in the safety and comfort of their home and at their convenience. It is just it's very efficient to do this, and I look forward to doing these types of sharing of information in the future. Okay, so let's get started. Always feel free to call me, email me with any questions, and certainly use that Q&A tab. All right, market declines. They are part of investing. Okay, so how often do they happen? Well, as you can see here, is a 10% more decline, 10% or more correction in the market happens about twice a year, or once a year. And we are currently, or at the market lows, was very, very close to. We're very close to this number here. At the peak of the top to the peak of the bottom, we were very close to the 20% decline. But that actually happened in December of 2018. Now, so this is not unusual. Okay. Declines are not unusual. When I do a financial plan for somebody, I keep in mind a financial plan encompasses their goals, objectives, how much money they need in income, when they need it, look at how much debt they have, what interest rate they're paying. I look at the whole picture. The investment side of their assets is just one portion of an entire mosaic of what they have going on in their life. Some of you may be retiring and taking income from these investments. Others may be using this as a buying opportunity and adding money on a regular basis. So it is all dependent upon you and your financial plan. So when this is normal, it happens often, once every 4 years, about once a year, about 3 times a year. Okay, so market declines are part of investing. Feel free to ask questions, comment. Hang on a second here. Let me get rid of that again. Clear all drawing. Boom. And there we go. Time in the market, not timing. You know, everybody wants to know, what's the market going to do? What's the market going to do? What's the market going to do? And have you ever asked that question? Nod your head if you did. People always want to know if that's the case. What's the case? You know, could anybody ever predicted this coronavirus? No. Can you predict where interest rates going up or down? No. I saw a study being done. and they actually polled former Fed chairmen if they could predict what interest rates did on a regular basis, and they got 60% of their guesses were incorrect. So even the previous Fed chairmen was incorrect on where they think interest rates was going to be over the next next year. Okay, so it's difficult to have any prediction in a near-term basis. Okay, so now staying fully invested. I say fully invested according to what your needs are. Every S&P decline of 15% or more from 1929 to 2018, when the recovery was over, the average first-year return was up nearly 55%. Now, when is the recovery going to happen? I do not know. Okay? And anybody who tells you they know, they don't know. It could happen starting tomorrow. It could. The market was up today. It could happen. This could be over. We don't know. We don't know. So that's why it's very important to have a plan. But what is the impact of selling out? Okay, so if you did invest, let's say in this example here, 10 years from 1/1/2009 to 2018, if you only missed the 10 best days of the market, the 10 best days only out of 10 years, your return, your $1,000 original investment grew to $2,700 if you were fully invested. If you only missed 10 days, it dropped by a third to $1,700 if you missed 10 days out of 10 years. So it is incredibly important to make sure that when you are investing and things are turbulent, that you seek counsel. Okay? You're doing a fantastic job by even being on this webinar. Fantastic job. So you are actually seeking advice now to how to think about certain things, and that is very, very good. Because when people are emotional, angry, upset, typically don't make the smartest and rational decisions. And so education and knowledge and counsel is one way to help reduce that risk. Emotionals can be hazardous. Of course, market tops, most people often buy there because they're greedy. Most people often sell at market bottoms. It's easy to see and justify buying real estate when everybody's making money in 2005 and 6. It is easy to justify all the reasons to sell when the stock market is down in 2008 or 2009. Okay? There's all kinds of reasons to justify that behavior. But thinking in terms of a practical, logical ways is in trying to reduce your emotional attachment to it is the best way to do it. And how do you do that? Well, again, good counsel and a financial plan. But I'm going to try this poll here. Is how many of y'all know somebody who sold when the market was down? And that could be this year, 2018, could be 2008. How many of you know somebody who sold their investments when the markets were down? I'll wait for those polls to come in. Make a plan and stick to it. I know you heard that. You heard me say that a few times already. So when I do a financial plan for somebody and looking at what their guaranteed income is, whether that be Social Security or a pension, what their debt is, what their payments are, what their interest rate is on that debt, how much money they need on a monthly basis, how much assets they have, and when do they need the income. Is it today? Is it tomorrow? Is it 10 years from now? When a plan is designed, I design it in a way to expect periodic downturns in the market. It is expected. It's built in. This, it is not, it is absolutely built and designed to be able to stand these type of events. Okay. Now I've been doing this I've been a financial advisor for 23 years, and I've got clients that have been retired with me for 23 years. They've gone through aging contagion back in the late 90s. They've gone through the dot-com bust, 9/11, flash crash, the real estate bust of 08 and 09, and they're still retired. Now, how does that look on a real life basis? Okay, does that mean that their money never went down? That is absolutely not true. It's not magical. Okay, so how it works in reality is that when you, instead of taking the family on a week vacation in overseas or in Italy or Paris, maybe they go to Florida or Hilton Head. Instead of buying a Mercedes for a next vehicle, maybe they get a Toyota, or maybe they wait. So it's not that people change, people move. Okay, it is, when things are a little bit tougher, people tighten their belts. When things are doing well, they spend a little more. It's not that you set a plan and it's fixed forever. Okay, I meet with my clients at least on an annual basis to update their overall plan. And if things happen either in the economy or with themselves individually, whether that be lose a job, gain a job, find out that they got sick, maybe have to take care of a loved one, they call me. Hey, Jeremy, hey, what happens if I need to do this? Or what happens if I want to do, buy my son a car? Or, hey, he wants to go to graduate school. What are some of the best options for me to do? That's life. That's what happens. And then when someone knows your overall picture, like myself, oh, hey, Mr. Smith, it's good for you to maybe in this particular instance, hey, put money in a 529 plan, get a state tax deduction possibly, and fund it that way. You can do it multiple different ways. Now, one very cool thing here is because I'm an independent financial advisor using Fidelity, I can help you, I can refer you to any number of institutions in the world to refinance your house, to do mortgages. I can do lines of credit from Goldman Sachs, from Tri-State Bank, from multiple different from U.S. Bank, from multiple different institutions, when I am not beholden to one company. Okay, I'm able to look out in the financial landscape and see which institution may offer you, client, the best pricing. I get no kickbacks, no conflicts of interest on anything. Okay, I don't use one institution. I can use many institutions, and whichever one is the best for you, because my pay is a fee based on advice. I'm agnostic on what you choose. So make a plan and stick to it. So and this is kind of cool here. So those of you who are not yet retired and you're adding a certain dollar amount every month, you buy more shares when prices are low. More shares when prices are low and less shares when prices are high. Okay? So like in month 4 here, the price per share went up and the number of shares you bought went down. And so, but if the share price goes down, my goodness, you're able to buy many, many more shares when prices are lower. So, and as someone who's saving for retirement, I tell guys, hey, take advantage of it. This is a good thing for you. If you're adding money, you are saving for retirement. You want it wanted to go down so you can buy more shares. But hey, Jeremy, what about me? I'm retired. Most of my clients are retired or right at retirement. They're needing income. So what happens when this market goes down and I need to, generate income for my life? Well, the portfolios that I've designed for people to generate income aren't, first off, they're not all in stocks. That's number one. Number two, very diversified. I'll get that in a moment. But they're not taking out 100% of their money today. It is designed in a way for them to generate income for 20, 30, some instances 40 years. So what combinations of investments in today's environment would give you, the client, the highest probability of success in generating income for you based on your goals for the rest of your life? That's a mouthful, I know. But most of my clients, they get the money on a monthly basis and they have the rest of it invested. Yes, it goes up and down in value, but owned over time, it tends to do what it's supposed to do. What is that, Jeremy? What is it supposed to do? All right, how do we have this thing invested, right? So diversification matters. All right, each one of these colors represents a different area of the investing world. Emerging stocks. Hang on, let me get the little pencil again. Emerging stocks here. Global stocks. International stocks. Or global small cap. Large company. International bonds. Okay, so emerging stocks are like China and India. Global small cap stocks are small companies overseas. International stocks, and so on. U.S. bonds, cash. All right. And so these just represents different areas. And on top here is the year. And the higher you are on this chart, the better you did in that particular year, and the lower, the worse you did, and so on. And so you see, there really isn't a pattern here. Of course, it would have been nice to be all in the U.S. here, right? But then, 2018, the market went down, and here you go losing 4.38%. So every one of my clients has a portion of their money in each one of these areas, okay? And it's designed that way so that when crap hits the fan like it does here recently, all of your money doesn't go down, okay? So cash and bonds recently have done fantastically well to help alleviate some of the downside they may have experienced in international stocks or global stocks or whatever else. And so it is designed in a way to, over time, generate either income now or income later for your specific financial plan. So again, this is a way to diversify investments. All right, clear. Perfect. Thank you for your patience. I'm getting the hang of this. There we go. Fixed income can be about, this is cool. So bonds, which are the U.S. bonds right here, they're like, Jeremy, it's only getting 0.01% this year. Well, why do you have that? Well, when things go down, when markets happen, and assets go down, bonds tend to do well. In the flash crash, it was up 3%. U.S. debt downgrade up 5%, and so on. So when stocks go down, which is represented by the pink here, the S&P 500, bonds tend to hold up quite well. Okay? So, yes, polls came in. Yes, many of you knew of someone who sold their investments when the market was down. Here's the thing. Let's say, for instance, that you sell, and the market goes down after you sell. Well, you have to be right a second time on when to get back in, on when to get back into the market. So you got to be right twice, and so which is nearly impossible to do. I've never seen anybody do it. That's the equivalent of someone, oh, hey, I'm playing a slot machine and I win some money playing a slot machine, and that person all of a sudden thinking that a slot machine is a good investment. It is not a good investment. The odds are against you in doing and repeating that behavior over and over again. It's just not realistic. Okay? So, thank you for the poll there. Global sell-off. So, bonds and diversification help alleviate some of the downturns. Perfect. Okay. Market trends. Okay, here we go. All right. There's a difference between being a player in the casino, pulling on the slot machine, and being the casino owner. The owner of the casino has the odds in their favor. Okay? Hey, can someone get lucky? Yes, that's true. That's true. But over time, the casino normally wins, right? So the same way goes with investing. All right? These are 10-year average annual returns. The average annual return from, call it from 37 or 1936 on, for a 10-year average is around 10%. Some years, a 10-year average is over 20. Some years, it's nearly zero. We had one recently from 2000 to 2010. I mean, it was right at zero. So, well, what happened? Well, okay. So there are dividends that are paid on the S&P 500. Okay. There's interest on bonds because you don't have all your money in S&P 500 stocks. Okay. There's other types of things. You've got guaranteed income from your other sources. Like, again, I've had clients who've been with me since the very first year I started in the business in 1997. And they are still retired. They play golf. You know, they go out to dinner. They have drinks. And they live their life. And so we've been able to, you know, update plans and make decisions and move along in the financial environment as life comes at us and as life goes on. Okay? So what are the takeaways here again? Number one, have a plan. Okay? So where is the plan? Make a plan and stick to it. So have a plan. When you have a plan, it's easier to be less emotionally attached to what's going on the tube on a daily basis. Okay. Next week, I'm doing a webinar that's going to be on how financial markets and media affect investments and affect the news. Okay. So there certainly is some movement when the media says one thing and does that. That's true. That is true. But if you think in terms of long term and your overall plan, and it's like, well, Jeremy, I'm 62. I need to live off this money. Well, yeah. Guess what? We have to prepare as a financial advisor. I got to prepare for you to live for another, call it another 35 years. All right. It's not that you cash it all out and you stick it under your mattress and you live for another 35 years off the money there. You have to do what's practical and designed to do what it's supposed to do over a 35-year period. Okay. So have a plan. Okay. Think in terms of being less emotional. Review your plan. Update it when things go down. Are you going to be okay? If you can invest, my goodness, invest. If you're retired, the worst thing you can do is sell. The second best thing you could do is stay put, because the dividends you're getting on some of your investments are reinvesting, hopefully, back in at lower prices. So without you lifting a finger, you're buying more shares at when prices are low. By the way, ask me any questions if you want to. Emotions. Yeah, a lot of times when we're angry, we don't make the best decisions. Okay? Understanding when people are fearful or angry, oftentimes good decisions aren't made. Okay? make a plan to stick to it. Remember diversification. Bonds, even though they may not pay as much as stocks, and stocks do great, they help alleviate some of the downside when they don't do so well. And long term, okay? Guys, markets average over 10%. I'm not saying that's what's going to average in the future. And I do not know when the recovery is going to happen. But if the odds are in your favor. If you do a plan, customized for your needs, you live within your means, you consult a certified financial planner like myself, your odds are going to be in your favor of being okay. Okay? So the markets are down. Yeah, for now. How long? We don't know. What can you do? Get your plan reviewed. Are you taking? I talked to someone. No joke. This is a couple months ago. He had a 401k. He left his previous employer, and decent sized 401k. And I'm like, hey man, you know, you're taking a lot of risk in this 401. You're telling me that you're conservative, but this 401k is very aggressive. And so with my advice, he changed it from like a 90-10 stock bond portfolio to a 60-40 portfolio. I mean, and that probably saved him probably $150,000, unaware of the risk that he was taking. So it's important to have your plan reviewed. One other thing you can do in today's environment, interest rates are very, very low. Check on refinances. The cool thing about where I'm at right now is that I have available, I can refer business to Anderson Brothers Bank, Crestcon Bank, South State Bank, Guild Mortgage, you name it. There's so many different providers out there of banking relationships that I'm able to refer people now instead of just one institution. All right. Okay, so I do want to talk a little bit about what's going on in the environment right now. So I can get research from Goldman Sachs, J.P. Morgan, Fidelity, Capital Group, BlackRock, trillions and trillions and trillions of dollars worth of research, and looking at the virus and where earnings are and whatever, you know, it could have an impact on the GDP. I mean, it could have an impact on markets. Is it priced into the stock market today? Don't know. You know, what can happen? We don't know what can happen in short term. But according to all of those institutions and all of their research, we could have a V-shaped recovery. What's a V-shaped recovery? Well, when the recovery does happen, it happens really fast. When will that happen? Don't know. Could be next week, could be next month, it could be 6 months. It could be drawn out a little bit. Don't know. You know, hey, Jeremy, why don't we sell out and then wait for things to settle down? Why? Why would we not do that? Because if we miss even the little, just very few days of the recovery, it has a dramatic impact on your overall return. A dramatic impact on your overall return. So think of downturns as expected, okay? It's just part of investing. You know, it's the equivalent of you going home and finding out that your air conditioner broke and you need to get it fixed. Right? Do you like it? No, you don't like it, but it's just you hopefully have built in enough cash where you could handle that, and you fix it and move on. That's how it works. But any questions? No questions. All right, so next week, I'm going to send out an invitation. We're going to do a webinar on the media's influence on the market. Okay? I've got a guy, a really good guy, who's going to be talking about that, and I'll send that out. But any questions at all whatsoever, give me a call at 843-222-6602, 843-222-6602, or send me an email, jeremy@riverbendwm.com, jeremy@wm.com. And thank you very much. Bye.